we could get into a phase where there's a spiral. People suddenly lose confidence in holding government debt and they all rush for the exit at the same time.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 17th through June 24th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, formerly in wealth management and Swiss private banking. Clive, thank you so much for joining us today.
Thank you for having me on your show.
What I really wanted to discuss today was the gold price. Now, over the last few months, we have seen a dramatic rise in the gold price above the $2,000 level. We are seeing a bit of a pullback here, but in the last few days, it seems like we might be starting a turnaround. But instead of focusing on, the day-to-day price actions, one of the things you've done recently is you've written an article about some misconceptions that people have about when gold rises. People think that gold doesn't rise on rising interest rates, but obviously that's not true. And there are some other points you made in the article as well about some common misconceptions. Can you expand on some of the points you made there?
Yeah. So first of all, let's talk about interest rates. We started with interest rates at 0 to 0.25% way back in 2015. When I say started, we actually ended at 0 to 0.25% in 2015. They raised the rates on December the 16th and continued raising them off and on all the way up to today's rate, where we currently stand at 5.25% to 5.5% in the United States. Now, normally people say interest rates or higher interest rates are the enemy of gold because the cost of carry gets that much higher. What it means is if the interest rate is 0, you can hold gold or dollars. It's neither one nor the other. You're losing nothing. But if interest rates go to 5.5% or 5.25%, and it's 5.4% roughly on the Fed funds rate at the moment, then you can put your money on deposit, earn 5.4% and earn nothing on your gold. So a lot of people think that gold should go down when they raise interest rates. But in fact, in that particular period, and this is not the only period, but I just took that as the latest example, that's the period from 2015, the end of the year, when they started raising rates, through to July 26th, when it reached the current rate of, that's July 26th last year, when it reached the current rate of 5.25, we saw the gold price rise from $1,072 to $1,970 an ounce. That's a 83.5% rise over the 7.5 years. That's 7.5 years when interest rates were going up relentlessly. So that's my first example. The gold price doesn't actually care about the interest rate. And this isn't the only period. If we go back in history, we'll find plenty more periods when interest rates were rising and the gold price was rising as well. So that's perhaps the first point, to not get too fixated by what the gold price will do according to interest rates. Although, of course, the conventionally held view is that lower interest rates, which many people now expect, ought to be good for the gold price. Well, we'll see if we actually get lower interest rates, but that's the conventionally held view. And people do think that probably we'll get one cut, best guess is in September, of the Fed fund rate, and maybe some cuts next year. At least that's the way the thinking goes. I'm not sure I totally agree with that, but I think the cut we might get might be the only one if we get it in September. Do you want to make any comments, or shall I move on?
Yeah, no, I think one of the important things here also is that the dollar index does not seem to be very well correlated with the gold price. We see the dollar rise often, you mentioned, and gold rises along with it. So, and I've heard the point also that the dollar index is more just, it's made up of a basket of other currencies. So it doesn't really tell you a whole lot about the dollar value compared to goods and services. It just kind of shows you that it's rising compared to other currencies, and it's possible that all the currencies are falling at the same time.
The dollar index and gold is a funny thing. There are times when gold does what's expected, i.e. the dollar's rising, gold goes down, and dollar falls, gold goes up. And there are times when it does the exact opposite of what I just described. So it's not a perfect indicator. I mean, one of the things to say about the dollar index, it's only measuring the value of the dollar against other currencies. And we all know that the whole world is on a printing spree. So all currencies in the world are buying less today than it bought a few years ago. And that printing spree and the increasing levels of government debt are continuing to increase. So realistically speaking, all currencies are really going down together. So the dollar index, when you see the dollar index rising, that's the DXY for those who follow it. It doesn't necessarily mean that the dollar is becoming more valuable. It's just becoming more valuable relative to other currencies, which are declining, and the dollar at that time is just declining less fast. But if I take the three most recent movements of the dollar index, we had two periods, one after the other. The first one when we're talking about the period here from January 2021, where the dollar index rose from 89.68 to 114, and the gold price did what's expected on the tin. It fell because the dollar was getting stronger. And the gold price actually in that period fell by about 14%. And then we had a period when the dollar index when the dollar index fell from 114 to 99. In other words, the dollar went down, and the gold price did indeed rise, which it's supposed to do. That's up 20%, 21% in that period. And recently, we've had a rise in the dollar index. So gold should have fallen, but it didn't. And it's got up another 18.5% since the dollar index rose. So the dollar index has risen recently from a level of about 99.1 to the current level of 105.39. And gold should have gone down, but it didn't. It did the opposite. So what that shows is that people aren't focusing exclusively on the value of the dollar when they choose to buy gold. There can be periods when it's correlated with what it's supposed to be doing, and periods like the one we're in right now, when it's doing the exact opposite of what you'd expect.
And you also mentioned kind of what's in store for gold going forward here. One thing is that we're probably going to see higher inflation coming, which might put pressure on the Fed to maybe not cut interest rates. But your perspective on the inflation that's coming, because we've already had a wave of inflation, and I know analysts have said, I know Tavi Costa at Crescat Capital has pointed out that in the 1970s, there were 3 waves of inflation. And if we're only we only had the first wave now, we're going probably into the second wave here. People better buckle up, because sometimes, the second wave can be even worse.
So historically, inflation has been good for the gold price. People buy gold during and ahead of a rise in the rate of inflation. Recently, we've had people buying gold during a period of disinflation. You see, we've seen since March 22, when inflation peaked at the CPI level, from 6.5% down to the current 3.4%. So we're talking about May 22 until now, about 2 years. The gold price has continued to rise. It's gone from 1,936 up to 2,324, which is 20% in a period of falling inflation. So that's seemingly an anomaly. Why are people buying gold when inflation is falling? And I think the reason for that is those who are in the know, the smart money, realizes that inflation isn't just at the level of consumer prices. Inflation is at the level of the total amount of wealth on the planet as created by the government becoming more and more indebted. So as the US government or any other government on the planet borrows money, they borrow money and put that money into the system. So the government gets poorer and everybody else gets richer. And there's a sort of leveraged effect of that as well. So because the amount of debt goes up, government debt, the amount of things that people can own go up as well, because they're going to rebalance. If they've got more government debt, they're going to rebalance and buy more gold and more equities and more other things, more Bitcoin, whatever it happens to be that they put their hands on. So we're now in a phase where people aren't looking at the consumer price index as much as they're looking at what's going on with the government debt. And they can see that the government debt is currently rising at an unprecedented rate. They can see that there is no current plan to address the problem of reining that in. The interest on the national debt is rising faster and faster due to the rise in interest rates. So as the old debt, which was taken out when interest rates were nearly zero, as that matures, it's having to be refreshed and renewed at much higher rates, as is the new money being borrowed, has to be borrowed at even higher rates. So the interest on the national debt is starting to accelerate away upwards. And the national debt itself is forecast, according to the government's own forecasts, to keep increasing and increasing as a percentage of GDP. We're obviously already long past the point of no return. So turning around will be very, very difficult. But we could get into a phase where there's a spiral. People suddenly lose confidence in holding government debt and they all rush for the exit at the same time. And we might be seeing signs of that based on some news stories which are coming out of the woodwork just today and yesterday about Japanese banks. So the story actually focuses on one Japanese bank in particular. I think I prefer at this point not to mention the name because I haven't done my full research on it, but they hold something like 70. Let me just have a look at the number. I'm going to give the number in dollars. We're talking about bonds that they hold. They hold $71 billion worth. That's in yens, that's 11 trillion yen. $71 billion worth of foreign bonds, which one can presume that they're mostly US treasuries. And that particular bank has announced they're going to sell the equivalent of 68 billion of that 71 billion because they're realizing losses on those bonds, and those losses are the interest they're earning on the bonds just isn't sufficient to cover their cost of funding, i.e. what they're having to pay depositors. So that's one Japanese bank alone who's basically announced that they're going to be unloading their Japanese bonds, 63 billion of that. Now, there's a lot of Japanese banks with a lot of Japanese bonds, I think. I haven't checked into the others. That was a bit of work I was starting on. But I'm quite sure that many of the better known banks, this is not a bank whose name you'll ever heard of. But I don't want to say it because I don't want to sort of put too much petrol on the fire here. But they are going to be selling bonds. Now, that could push US interest rates up. It could be the start of a loss of confidence in US government bonds. So I think we've got to be a little bit careful. There might be a rush at any point in time, we never know, by holders of US government debt to sell it. And now what happens when that happens? Clearly, the government won't let it get out of hand, and they are likely to expect the Federal Reserve to do what they would consider the Federal Reserve's duty, and that is to act as lender of the last resort, specifically by buying the government bonds that the US government wants to sell or that the public at large is selling. But how does the Federal Reserve buy bonds? Well, the only way to buy bonds is to print the money electronically so it can buy the bonds. The liability side is the money it prints, and the asset side is the asset it buys, the bond. So I think if we do get into a sort of panic phase over US government bonds, let's say interest rate on the 10-year goes to 5% or something like that, and maybe that's too much, maybe 5.25, I don't know where the level, where one would regard it as a panic. But if it gets too high, I can see the Fed stepping in and starting to buy bonds and printing the money to do so. So that, of course, turns us into a highly inflationary phase because whilst bonds are the government getting poorer and everyone else getting richer, they are, of course, long dated, and there's a period before you can actually spend the money when the government actually turns it back into cash. But if the Federal Reserve steps in, that's cash in circulation immediately and much more immediately spendable, and it's going to find its way into the gold price.
Now, if countries are going to be dumping U.S. treasuries, what do you think they'll be putting those funds into next? Do you think they're just going to be buying more gold, or where do you think that money is going to be going?
I think a lot of it will go to gold. There aren't that many alternatives. They can't buy Swiss francs. There just aren't enough of them out there. That's not possible. There's not enough Swiss bonds for them to make any difference there. They can buy European government bonds, but the problem there is European government bonds and UK government bonds go in the same direction as the USA. They're all pretty correlated in terms of what they're doing. So I don't think the money can go there. So I think gold is an alternative, is an obvious alternative. It's the money which has existed ever since the beginning of time. It's been the backing of all banking systems ever since the beginning of time. And even today, the vast majority of central banks are hanging on to their gold for dear life because they realize that there might be a change in the monetary system. And the more gold you've got, the more influence you'll have on the new system. So I think it will definitely go to gold. I mean, I'd like to think that at least one central bank might be a little bit adventurous and buy some Bitcoin as well. If there is one which is going to do it, it would be the Swiss National Bank, I think, who are not, very favorable. At least the Swiss are very favorable towards Bitcoin, but they've not made any signs of doing that other than to say they haven't found it to be an essential component of their reserves at this point, but that might change.
Now, when it comes to central bank buying, I know we had a story come out, right, that China had stopped their purchases of gold, but they just really didn't buy gold, I believe, last month or one of these months here. So your perspective on the Chinese buying going forward?
Yeah, that was a very distorted story. I think it might be Bloomberg or it might be Reuters, but one of the two came out with a story that China didn't buy any gold or hadn't bought any gold or something like that in the month of May. And that story then got repeated by many other news agencies relying on the initial story, saying that China had announced that it hadn't bought any gold. So I went looking for this story, looking for the announcement. To the best of my knowledge, I have not been able to find any announcement. I have searched high and low. I also searched high and low for the evidence that they had stopped buying. It is true, but it was very hard to find at the time because the figures weren't yet on the World Gold Council website. In the end, I managed to get through to the central bank, a statement of the central bank's reserves, all in Chinese. And I put it through Google Translate or something like that and managed to figure out it's true. They didn't buy any gold in May, but to the best of my knowledge and belief, they didn't make an announcement that they hadn't done so. And they certainly didn't make an announcement that it was the end of their buying. So I don't think it's the end of the buying. I think what's happened here, gold price was moving upwards certainly all of this year. And probably they said, you know what, we'll just take a pause. Maybe we're driving the price up too much. But even after they stopped buying, and they stopped buying in April, and that's not a permanent stop, they just didn't buy in May. Despite that, in May, towards the end of May, the gold price hit an all-time record. So it shows actually that the gold price doesn't actually need China as a central bank buyer, and they were the biggest buyer officially, to hit all-time records. Do I think the Chinese will resume their buying? Yes, I do. And the reason for that is they're way behind many other countries in terms of the amount of gold they've got. They've got less gold than Germany and Italy, for example. So I think they're going to, and less than Switzerland, I think. So I think they will pick up their buying because they would like to get a lot closer to what the United States has got. And that will take them many, many years of buying because you can't build up the difference in such a short period of time. So I think they're coming back to the market. Of course, the greatest thing the Chinese could do for themselves would be to make an announcement. We think the gold price is too high, then the price will crash, and then they can dive in and mop it all up. That would be market manipulation, of course, and probably illegal. But suddenly having that month of pause did cause the gold price to drop a couple of $100. And it wouldn't surprise me if they're sitting there with a relatively low bid, probably at 23, 25, something like that. Where are we today? We're 23.40 now. And I suspect any gold which comes on the market, they're mopping it up in the current month.
No, what I find really interesting is it seems like, I guess this is kind of a what if question, or it's not so much a what if, it's kind of a when question. But when we see these countries moving towards gold and moving away from the US dollar, can you kind of give your forecast of what will that actually look in practical terms if gold is seen as money again, or actually used as money again? I know, Ben Bernanke famously said that, it's just tradition is the reason why central banks own gold, but obviously that's not the case, and there seems to be steps towards making it, used as money again. So what do you think the real impact will be, especially in the West, where the impact of the dollar being the world reserve currency is definitely felt quite substantially?
Well, I think relatively speaking, the dollar remains strong until it doesn't. If we have a crisis with a major Western currency, I suppose it's going to come from somewhere other than the dollar first. Could be the UK, Europe, or Japan. But when a crisis happens, every other country, every Western country will say, oh my God, we could be next. So there'll be a knock-on effect. And people at that point start to seek alternatives. And if there's a generalized loss in the value of the currencies, that would be a national emergency and a brilliant reason for the government to take some emergency action, the net result of which would probably mean that if you happen to own government bonds, you're not going to get much value out of it. So what I'm talking about here is the possibility of using a crisis to effectively change the currency in some way. So we now have a sound currency. But I don't think the US government or any other government of the planet is going to say, we're backing our old government bonds with gold. I don't think that's a likely scenario at all. I think they might say, we're backing our current currency with gold, perhaps, but you can't change. If your bonds mature, you can't turn them into gold. Or they may say, we've got a bilateral currency. We've got two currencies running side by side, just as we had in many countries after the Second World War, where you could have as much money as you wanted, but you couldn't actually spend it unless you had a ration coupon to go with it. So if we have a crisis, people are they're going to have to bring in some form of confidence, and the obvious way to bring confidence to a currency would be to have some sort of backing where it's genuinely believed that people could convert their currency into something tangible like gold. It's no good having a promise which can't be fulfilled. We obviously might get a promise that this will work for international trade, but not for the private individual. But if you're in a distrust situation, you really need something more than just saying governments can change their money. You need to have the man in the street believing he gets value for his cash to restore the confidence. So I think there's a high chance that gold will play a role in a future monetary system. And I think there's a high chance that in whatever the future monetary system we have, a lot of the old fiat-based assets you have, and by that I mean bonds and potentially cash or money market funds or deposits, you won't be able to get full value for it. That is the history of money. Ever since the beginning of time, currencies have failed as confidence eroded and been replaced by something which has got a better backing than the one before, until they debase that one. And I think it's just a cycle which will continue, perhaps in a much more sophisticated way. I don't think it'll be done in the way that it's happened in the past. There are many ways which it could happen. I mean, it could be some sort of bail-in where they requiring everybody owes deposits or something to lend it to the government at a low interest rate. They've done that in Brazil, for example. It could be where they have some sort of dual currency system. That would be, for example, when we bring in the central bank digital currency, the CBDC. They could quite easily make it a rule that although you can change your money from dollars to CBDC dollars, same thing, one for one, the only thing you're allowed to spend are the CBDC dollars. So before you can spend your dollars, you've got to put them into the CBDC wallet, either on your phone or the CBDC wallet held by your bank on your behalf, and then they can be spent, albeit for money laundering reasons, for tax evasion reasons, to make sure they know what's going on and controlling the economy. But of course, it would be all too easy at some point to bottleneck that and say there's limits on what you can put from your bank account into your CBDC wallet, because people are speculating against the dollar or speculating against the bond market or buying up too many toilet rolls, whatever it happens to be. And therefore, we're going to limit how much you can move from left to right, or perhaps you need permission to move from left to right, or perhaps you can't do it at all because the crisis is so serious that we're now effectively running the entire country and the economy on what has de facto become the currency of the country, because you had no choice. You had to do everything in the CBDCs, and what's not in CBDCs today is left behind. Bad luck. And okay, we'll compensate the pensioners, we'll compensate those who are poor with small balances. But if you happen to be very rich, or if you happen to be overseas, or you happen to be a foreign pension fund, well, bad luck.
Now, do you have any updated thoughts on how people can really stand up against this central bank digital currency reset? I know one thing that I personally have done is use cash more, right? So it forces businesses, it's one way to take a stand to force businesses to, continue to take cash. I still think it's funny because it's just pieces of paper, right? But it's at least one step removed from, the digital matrix. Your perspective on maybe ways that people can stand up and fight against this, or are we too far gone to actually make a difference that we have to just kind of protect ourselves at this point?
Well, first of all, we don't know if the central bank digital currency will come in. There's a lot of opposition to it all around the world now, but I fear it will come. And in terms of the existing use of digital cash via your credit card and so forth, it's become all too common. I'm guilty as any. I pay most things with my watch. I just flash my watch in front of the card reader and it's done. It's very convenient. And I can see that trend continuing, even though it's bad for cash. But what can people do to protect themselves? I think you're kind of fighting a losing battle by forcing businesses to take cash, which they don't want to take in the first place. We already seen a number of countries where that's faded away, like Sweden, for example. I think you can't spend cash in Sweden. China's another place where if you want to pay something, you haven't got a WeChat phone with your cash card on it, you're stuck. So tourists in China are having a great deal of problems nowadays because people don't take the cash anymore. So what can you do? I think the ways to do it is to own other things. And if I just outline a slew of things people might want to consider. If there are things you'd like to buy and you're thinking of buying them next year, whether it means getting yourself some surgery, or maybe getting an exercise machine or something like that, or going for some expensive dental treatment or anything like that, you've got some birthday presents to buy for your children, your grandchildren. Well, for small amounts, you could do that now. Have a little stock of things. You could buy the tools that you're going to need next year or the year after. Or maybe you're thinking of owning a bicycle and one of these new state-of-the-art bicycles that are out there. Well, why wait? Reduce your cash balance while you can. Another great thing which I believe in is self-custody of anything. And one of the greatest things you can self-custody is your own home. So if you don't own a home, and you've got the ability to buy one somewhere, why not? If you have one already, well, think about what you can do to improve it. Home improvements, it could be a loft conversion, it could be an extension, it could be putting a greenhouse in the garden. There's a lot of things you can do to your home to add value to your home. It could be changing the heating system. If you've got money in the bank and it's burning a hole in your pocket and you feel uncomfortable with it, spend it on something. So that's obviously, they're not financial assets that I'm talking about there, but it's certainly a way of reducing your balance into something which is in your custody and is not going to be very easy for someone to take it off you. And in that respect, of course, gold is also, if you have physical gold in some way, shape or form, if you keep it in your bank safe, for example, to all intents and purposes, it's in your custody. But you, of course, still have to ask the bank for permission to access your safe. So if you don't like asking permission, then bury it in your garden or under your pillow or wherever. But gold could be a solution, as could Bitcoin. I think the number of people who own Bitcoin at the moment it continues to increase. I think there's about 7 million wallets which earn more than $10,000 worth of Bitcoin. So the number of people who have some Bitcoin is growing out there. So there's a good number of people who will take it off you at this moment, and I think that number is going to grow. That's self-custody if you have it on your own wallet, not if you have it at an exchange, and not if you have it through the ETFs. But that would be a way of self-custody. Otherwise, you're now going to the financial assets, but you don't buy. I would say don't buy bonds. That's the risky asset. Go into own companies from all around the world. Most companies are headed up by very experienced and knowledgeable boards of directors who are paid a lot of money to navigate the troubles of the world. So even if we get into a currency crisis or an interest rate crisis or whatever other sort of crisis it might be, I would reasonably expect most companies and boards of directors will be thinking about what we can do to navigate this crisis, just as they did when we went into the COVID crisis. They all immediately started improving their websites and setting up home delivery services, and all kinds of things suddenly appeared out of nowhere so companies could stay afloat. And I think that if we go into a crisis, companies will be doing their best to protect the value of themselves and therefore their shareholders. Of course, you don't want to be necessarily only invested in one country because you don't know how bad things might get in a particular country. But if you invest globally, you'll have what the value of a lot of businesses are worth. The prices could go down, they could go up, but at least they'll still be there, even if the currency of the world gets reset.
All right. Well, Clive Thompson, thank you so much for joining us today. We really appreciate your time and insights as always. If our viewers are interested in learning more, I know they can find you on LinkedIn and your articles posted there. Can you share with us about that?
Sure. So I post regularly on LinkedIn. I write articles about the Federal Reserve. There's a very interesting article I wrote about a letter that Elizabeth Warren wrote to Jerome Powell last couple of days, in which she's urging him to reduce interest rates. But obviously you can read between the lines and see that's an order, in my opinion. And I wrote a rather facetious, reworded version of that on LinkedIn. I think people might enjoy that. But yeah, look me up on LinkedIn. You can connect to me, and I'll answer any questions that anyone's got about their finances or investments or anything generally. I even get questions about whether they should sue their next door neighbor for water damage, which is actually not my cup of tea. But I get a lot of financial questions where people have inherited money or don't know what to do with the money, and I'm quite happy to try and point them in the right direction.
Fantastic. Well, Clive, we really appreciate your time. As always, thank you so much, and God bless.
Thank you very much, Elijah, and speak to you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 17th through June 24th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo Bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.